Hi, Matt McAleer, Director of Equity Strategies, July 21st. Boy, summer ripping by, the year ripping by. We're a little bit of the dog days of summer here with the Moose, although there was some action in some of the earnings release names.
Yes, and that's where the action was.
That's right. The indices, the broad indices, fairly quiet, but you had plenty of action in some of those growth names. Mentioned last week that the one concern or fear I had coming into this earnings season was some of these names had run so hard was the earnings already in them.
Right.
And you saw that out of some of those hot stocks, Tesla and a couple of the semiconductor stocks. The flip side of that was what was very interesting this week, and that was the strong bid in names like J&J and the drug and pharma space that's been quiet all year. Remember, drugs, pharma held up very well last year in 22, but this year with the bid in growth, it's been quiet. That all changed about 10 days ago. Started to see a very nice bid. We're actually trying to place some of that bid in drugs. Today, we bought some of the large biotechs in US ETF, just trying to catch a little of that updraft because we are long drugs, we are long healthcare. That's worked.
And they had been oversold too.
They had been oversold. They were 2 steps forward, 1 step back. Really sustained buying this week. So some of the areas that reported solid earnings but hadn't done anything caught a bid. We're seeing that, and we've seen that really for 6 weeks now, John,
right,
where equal weighted or value has kept up nicely with growth.
Right.
So as we see that shift, more diversified portfolios work out nicely.
Right. Yeah.
How about you, Moose?
Dog days of summer in bonds too. You don't want to say it was a yawn, but you look down for the week from last Friday to now, and basically the 2-year Treasury is around a 485. That's up 5 or 6 basis points. 10-year bond is right where it was, around a 384, 385. No change. It did it, though, in a backdrop of continued, I don't want to say disappointing, but slower numbers, slower and lower, whether it's new home sales, whether it's existing home sales, whether it's building permits.
Yeah.
The Philadelphia Fed Index was another negative number. All of this is just kind of saying that even with the stock market doing well, the economy is just downshifting a little bit, and that is to be expected, and we think that's going to continue. A lot of it's going to depend on the inflation numbers. We have the Fed next week. We know they'll probably raise the Fed funds rate target to 5.25 to 5.5. Another rate hike is by no means baked into the cake. We're going to have to see what inflation does, I think. We know the inflation numbers were pretty good last month. We hope they continue to be okay. We know the year-over-year numbers will probably go up a touch because last year, summer in July and August, they were very low. They'll be replaced by slightly higher numbers. But on the good news, you look at something like the Muni bond funds, which we know were the absolute bugaboo last year.
Right.
And now you're back to where you actually saw $1 billion of inflows into bond funds this week.
Yeah.
And it tells you that as bad as last year was in the bond market, is that some of that is in the rearview mirror, and people are picking up their heads and saying, that's pretty attractive yield, whether it's a 4% muni bond or a high 3 treasury or a 5% taxable bond.
Yeah, I almost cringe when I see whether they're friends or clients wanting to sell bonds here. The market, the equity markets tend to pull money in when they get hot.
Right.
And that's understandable. But it's been 15 years since you could buy yields like this. And to be just reallocating out of bonds blindly here, just give it a second thought.
I couldn't agree more. And when you think about from where you were to where you've gotten to, and we know some of it was all depressed by COVID and what was going on, right? But you were printing long muni bonds below 2%, 1 something.
This was just 24 months ago.
Less. Terrible.
Yeah.
And now you're producing bonds in the, 4.25-ish, give or take, sometimes a little more, sometimes a little less. That is a big difference when you think about buying a bond that's going to lock that in for a few years, even with some interest rate risk. And it goes back to something that our old friend in the municipal bond world, Jim Lebenthal, used to say. And he used to say bonds are the workhorse of investments.
That's it.
And that is very true for what you just said. They're providing that yield now, which is a workhorse in part, not all, but in part of people's portfolios.
Yeah, great point. I do think we're going to have some action to discuss with you over the next few weeks. August in the equity market, as you know, John, is traditionally the most volatile month. And some of that is volume related with some people on vacation.
I was going to say, people being away, it's like they're at the beach.
The volatility in August and September always keep us on our toes and will give us some opportunities in some different areas. So enjoy the weekend, and we'll see you next Friday.